Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, February 24th, 5:31 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week, and update the world famous 21 over 21 leaders list. Market looking red, leaders still holding up strong. State of the market, uptrend, short-term caution because we're stuck below the declining 21-day moving average. That's our short-term trend indicator. You can see over here on the trend gauge, that's big, bright red. Four closes now below the 21-day moving average, not really showing any propensity for a bounce or a challenge of it. Leaders still showing bullish, yellow sub arrow. A couple fell off this week. Actually, four fell off this week, but like I said earlier, I've got I've got at least a dozen lined up to eagerly take its place. So there is leadership quality. There are leadership quality stocks holding up. The indices are a different story, though. Medium term, we're still showing bullish, but the down now with multiple closes below the 50-day moving average. The arrow pointing, that's responsible for the yellow sub arrow there. And long term showing neutral. We're above the 200-day moving average, but we can't get the slopes of the line to commit to trending higher as we continue to trickle lower on the indexes with stronger economic data that keeps coming out that frankly I don't think the Fed counted on since their last FOMC meeting. This is the fourth piece of significant information that would lead one to think that they need to keep rates higher for longer. The first being the February 3rd employment data that was extremely strong. We'll get another one a week from today. The February employment data will be released next Friday, and maybe all of these tech layoffs that we've been hearing about will have worked their way into the system, and it'll show employment cooling. However, we've also got inflationary economic data. We had CPI, we had PPI, and then this morning PCE data, and that's mentioned in the what just happened. PCE inflation data came in stronger than anticipated, led to a gap down. We broke the 50-day moving average, tried to get back above the 50 twice, and it looks like as of right now, the 50-day moving average has flipped from support that it was Monday through Thursday to resistance at least today. On the bright side, we did bounce at the 200-day moving average, both the NASDAQ 100 and the S&P 500. Here are the final numbers. G6, this is our 6 ETF growth proxy, down 1.29%. S&P gap down 1.2, made a couple of rally attempts, still closed down 1.05. NASDAQ 100 down 1.7, Dow down 1%, mid caps continue to lead, down 0.6%. Russell 2000 down 0.94. Global diversified 60/40 stock and bond down 0.98. This was with the global equity index down 1.3, the global bond index down 0.46. Bonds were lower across the board, which of course means rates are higher. That was what we saw, the outcome of the PCE data today. In-house GROTECTION down 0.72%. We further cut our exposure today on the close below the 50-day moving average. So let's get right into what we do here at Revere, and I'm going to bring up the all-important, not that. I'm going to bring up the all-important 13 bear markets. We're treading on thin ice again. The 200-day moving average, the last line of defense before we really have to start paying attention to whether or not we're going to continue to deteriorate and possibly challenge the lows from October, or is the market going to find its footing and try to challenge at least the short-term moving averages to get back above them, and the 50-day, since this was our first close below it today. But we are risk managers first here at Revere. That means that we do not want any of our clients, especially those approaching retirement, to take a massive hit to their portfolio. So we manage risk, particularly when we're under the 200-day moving average. And why is that? Because every single one of these bear markets occurs once you break below the 200-day moving average on a weekly closing basis. Didn't happen today. We got back above it a couple of weeks ago and we attempted a rally. Then that strong employment and inflation data came in. Uh, Put the screws to the rally. We've been pulling back since then, broke our short-term moving average, broke our medium-term moving average, and now we're sitting on the long-term moving average. And if you're interested in an active approach like this that keeps you out of trouble, keeps you away from these 30, 40, 50% drawdowns, give us a shout. You can email me, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com. Dan coordinates getting the quick and easy paperwork to you to sign online. It's just a couple of e-signatures, and you can become a client. You can roll over an old 401k, an old IRA, and our nightly videos will guide you through exactly what we're doing and what our outlook is on the market. So email Don or Dan at revereasset.com or call 855 Real Wealth. That's 855-732-5932. So here's the S&P 500. And you can see the red line, the undercut today, the black line, that's where we bounced. Let's bring it up on, let's go to a 60-minute chart first of all, because we did bounce at not only the 200-day, but this 3950 has been a critical area going back to January. First, it was resistance when we were trying to rally up in early January. Then it served as a little bit of support on the pullback, especially here in late January. That's where we held 3950. And then we tested it today, undercut it, closed back above it. So we got 3940 is the 200-day moving average, 3950 is this key level, and then right above us, 3980 is the 50-day moving average. Let's go to a 5-minute chart and you can see basically it was a tale of 6 waves today, one down, one up, another down, another up, another down, and a bounce into the close. So 6 waves, as opposed to yesterday, which was a very clear cup with a handle. The gap down after the PCE data, not good. Now, what I don't like about this is yesterday's low, 39.69. Tried to get back above it here, failed. Tried to get back above it here, failed. That basically coincides with the 50-day moving average. We spent, what, an hour below it here yesterday. Gap down above it, couldn't get back above it. That's a bad sign. You don't want to see a big support area flip to resistance. And right now, that's what we're seeing with the S&P 500 and the 50-day moving average. Let's go to the NASDAQ 100. Do note that we're in oversold territory here, but that doesn't automatically mean buy. We need to see some strength and the stochastics hook up. So here's the NASDAQ 100 bouncing also at the 200-day moving average, which is trying to flatten out. 290.14, 2 cents lower from yesterday. So it really is trying to flatten out. 50-day still below the 200 because of how long we lagged. It was 4 or 5 months lagging, August, September, October, November, December, until we had the big NASDAQ stocks. People basically sold them late last year, bought them back in January. That pushed the indexes up. Bullish from the FOMC on February 1st, bearish on jobs February 3rd, and it's been a pullback ever since then. So there's your NASDAQ 100, very critical next week's low, 290. That needs to hold just like today's low on the S&P, 3943 needs to hold. Let's go on to the Dow Jones Industrial Average, which you would think normally would hold up better, not significantly better. You can see relative strength actually closing down on the week versus the S&P. There's some high price stocks in here just not acting very well. Broke the 50-day, didn't make any attempt to bounce back up through the 50-day. That's the red line, kind of a waterfall looking action there on the Dow Jones. It's also oversold. Let's go to mid caps, which have been holding up the best. Also coming into oversold, haven't touched the 50-day yet. The declining 21 is acting as resistance on any attempted move higher there since we broke it on Tuesday of this week. And small cap, same thing, broke down on Tuesday, tried to get back above on Thursday, failed, gap down again. At least we closed at the high of the range on the day for the small caps and mid caps. And note we're coming into oversold there also. Let's go to the VIX. We know earlier this week the VIX made a trip back above the 50-day and the 21, which they'd been underneath for months. And this move up on the VIX coincided with the move down in the market, with it was breaking the 21. The 21 is starting to come up through the 50 on the VIX. We're at this 21 level here. We want to get back below 20 here, which is when the market was making its most progress. How about the dollar? When we saw that strong inflation data, the dollar showed strength. Look at the gap up and the close at the high, and it held that strength all day, traded in a tight range, no give back on the dollar up into the 200-day moving average. Now, note over here in December, the dollar index did obey the 200-day moving average when it was coming down for 2 weeks. And then it broke it, tried to get back above it. This was a case of support turning into resistance. We'll see if this is still resistance when the dollar gets up there. We are overbought, very overbought on the dollar. So the setup is there between the bounce off of the 200-day for the S&P and the NASDAQ. The fact that we're oversold on the dollar. We're also oversold on yields and overbought on yields, overbought on the dollar, oversold on bond prices. So the setup is there for rates to come back a little bit and give a bounce to stocks. But a setup is just that, a setup. It needs a trigger. RSP equal weight down less than the Nasdaq by 20 basis points today. Equal weight Nasdaq down 17 points less than market cap Nasdaq 100. Nothing significant there. So let's flip to bonds now, and let's start off with TLT. This is where the biggest move was. Hasn't made a lower low, but still down 1.3% today. Let's go to the broad bond index, BND, down 0.55%, making lower lows. LQD corporate bonds, not making lower lows yet after a 2-day bounce. JNK junk bonds, actually closed at the top of the range, similar to the way stocks did, but acting better than the straight up bond indexes are, which is a bit odd. TNX, the 10-year note made a higher closing high. Well, let's see, did it last 39.55? No, we closed at 39.49. Intraday it did, and then pulled back a little bit into the close. How about the 30-year? This was also up, but not making a higher high. We own TBT and have really been benefiting from these increasing rates as this bounced off of the ADMA, but we're actually using the TLT. You use the underlying when you're. The TBT is based on the inverse TLT, but you see the TLT failed into the declining 8. They're acting pretty much in sync. The TBT is 2 times inverse TLT. But it failed at the ADMA. TLT getting back above the ADMA will be our signal to take our profits on this TBT trade. Note also it's rolling over from overbought, just the opposite of the way TLT is trying to come off of oversold. So how did gold do today? Well, the dollar was up big. What would you expect? Yep, gold down 0.71. The stochastic just absolutely buried at zero. Haven't seen it this buried in a while, but not showing any propensity to bounce, especially with the continued dollar strength. How about GDX, gold stocks? Yeah, they suck too, making a lower low. And silver SLV, geez, major lower low, down 2.75% today. What are the precious metal bugs saying these days? I used to follow them. I now know better. I can't imagine what excuses they're making. It's manipulated. It's the cabal. Fiat is worthless. Blah blah blah. Price and volume is all that matters, no matter what instrument that you hold. Bitcoin down 3.55% on the day, also reflecting the risk-off nature in the stocks. Let's go now to the tail of the tape, and you can pause here if you want to read through the whole thing. The key highlight, the data that came out. We went from up 1 to realizing we've been down 5 of the last 6 sessions, 6 closes below the declining 80 MA, 4 below the declining 21. Here's how we came in with our expectations. Break of the 50-day, we're negative now. Um, and we broke that 50-day support, did hold the 200-day support on the NASDAQ 100. Here are the 6 waves that I talked about. The dollar and bond yield strong. Gold and silver stocks were the worst. CKNY, as you might imagine, the tech sectors were down today. What we do in house? Well, Boeing, uh, the company that can't get out of its own way. Supposedly minor, but fuselage problems on the Dreamliner delayed a gap down between the weakness in the market and the gap down below the 50-day. We exited that position for a small loss. Sold ERX as XLE broke below the 200-day moving average, clawed back toward the end of the day as oil reversed, but we hit our stop on that. And we trimmed net and Airbnb, Airbnb continues to be a massive disappointment. So our exposure from 0.93 to 0.80, this is in keeping with, it's basically the max exposure that we want to have as long as we're below the 50, below the 21, but still above the 200-day moving average. And we'll go through all these charts when we go through the 21 over 21. Bottom line for today, PCE inflation data gap down, break of the 50-day, bounced at the 200-day. That the 200-day bounce goes for the NASDAQ 100 and the S&P 500, and those are the key areas that we need to hold next week. So let's get to the 21 over 21 list now. First of all, what fell off from last week? Something we owned up to a 5% size. We were pyramiding into it as it worked. Basically, everything stopped working this week. Uh, Multiple closes below the 21 on ON. Say goodbye to that. Boeing, gap below the 50. This had a stay of execution last week on the 21. Probably shouldn't have even been on the list, but we did rally into the close last Friday, and this one did rally nicely. Then it looked like the 21 was acting as resistance for it. It was still kind of outperforming the market earlier in the week until today's gap down. Boeing, say goodbye to my little friend. MBLY, Mobileye, well, Intel's cutting its dividend. They're in cost-cutting mode. Maybe they'll be selling some Mobileye shares to raise capital. I don't know, but whatever. Since they announced that, Mobileye has not shown any strength whatsoever, breaking below the 21, coming all the way down to the 50. This is not a leadership stock. If you get to 48 and you close the week at 38, that's just a brutal move in the span of a little over a week. So Mobileye had a nice run after earnings, but when push came to shove, it gave up. Speaking of giving up, Bros on earnings, gap down. So far, the gap down low is holding, but we couldn't get back above the 50-day today. But Bros below the 200 and the 50 also gone, and those are the 4 that got kicked off. So let's get into the 21 over 21 now, and you can see the ads as well as the survivors. Bad week like this, only to see only 4 kicked off, that's actually pretty darn good. Super Micro, putting in a super performance the last 2 days with the market being down. This has been acting great since its earnings. Now, it broke down before earnings. Here's the earnings day, and it absolutely has worked perfectly since its earnings report. Now, we're used to seeing these on big gaps higher with no overhead, but it fought through all this overhead and tried to break out today. So this is a case where, day 2 higher high, day 3 higher high, 2-day pullback right into the 8, bounced off of that. Market got a little tough. So finally broke below the 8, bounced at the 21, 2 nice bounces. Look at the lower volume pullback on these 3 days down and the big volume buying at average, at least the last 2 days, very clearly bucking what's going on in the market. SMCI, the first ad. Next up, Palo Alto. We bought this on day two after its gap up. We didn't buy it on its gap up. But when it recovered off the lows yesterday, we took a position, very nice, tight inside day today, only down 1%. This is being accumulated, plain and simple. In a better market, this thing will take off. SARK, we've been in and out of this and ARK, depending on which one was leading. Sold SARK on the strength yesterday, but the gap down telling me I should have held on to it. It's now above the 21 day. This is a good counter if you're holding on to some growth stocks and you're worried about them pulling back. So SARK rounding the 80 MA and the 21. That's the short ARK ETF, by the way. And Iridium, we already own this. I'm back. Let's see, 18, 19, 20. There's one that moved in here because it's one that we already owned. I'll get to that in a minute. So Iridium here, normal pullback into the 8 after its really nice move up on earnings. Net pulling back right into the 21. Would expect a little better action, but note the volume has been below average during this pullback. ANET bounced twice at the 21 today, very clearly that if it breaks the 21, it'll be sold. GFS, I sold this on weakness, but it did recover to get back above the 21. But note the little bit of volume on these attempted moves higher. TMDX, this was something that we owned. It got taken off last week because it closed. Actually, it didn't close below the 21. But I didn't sell it. And then we had a 1% position and then a massive move on earnings, up 20.55% on 493% volume. And despite a terrible day today, up another percent. Very clearly being accumulated, and this will go higher as a leader if the market continues. Only problem with it is it's not very liquid, 372 at $78, but expect this to trickle higher. Note the slope of the line of the 50-day average volume is going higher, and we expect more of that. Anytime you gap up on earnings, you're going to get the attention of the hedge funds, especially if you're up 20%, close at the high and make a follow through high the next day. Airbnb, very disappointing since making a day two higher high, 5 straight down days now. Yes, below average volume, bounced at the 21 and the pivot. So we reduced a little bit of that now. We've gone from a 7% position to a 1.5% position. TBT, already talked about this, working great as long as interest rates continue to go higher. ALGM, just going sideways during a weak market. NVIDIA, we bought this week after hours and then added on the gap up. Briefly pierced today's low. Corresponds with the recent high, so it's got support there. Closed back inside the range, 2% position on this, looking to add if the market rights itself. American Express hanging right around the 21 here. ACLS, semiconductor, going sideways this week. Anything that went sideways is a winner on a week when the market was down. ELF continues to be a champ, holding the 80 MA. DT, couple undercuts, poking its head below the 21, but back above it by the end of the day, both on Tuesday and on Friday. AI making a huge triangle here, holding the 21. If it breaks the 21, I got a feeling this thing is going to waterfall lower. Tesla holding up fine. If the market rights itself, it'll make an attempt at this declining 21. They've got a big AI meetup, or they're hosting something next week. I would expect some reaction out of that. But for now, just going sideways after moving up from 100 to 200 in the span of 5 weeks, just going sideways, both in price and a relative basis, is a very strong accomplishment, no matter whether you love Elon or hate him. RVNC, 2 up days the last 2 days. This is the Botox replacement. They've got earnings next week. GE continues. I mean, really, it's just going sideways after this big move up as funds repositioned inside of it after they spun off GE Healthcare. 2 bounces at the 21, and that is your 21 over 21 leaders list. Remember, folks, It's not how much you make in the market, it's how much you can keep. Stick with us at Revere. We'll keep you on the right side of the market. Do these videos every night, podcast on the weekends, and cautionary as we break below moving averages, big line in the sand here at the 200, we need to hold it. We'll see what next week brings. So wrapping up the week ending, February 24th, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great weekend.